Alright, gather round, you curious minds, because today we're diving into the digital trenches where code meets cash. We're talking about machine learning in finance, the idea that algorithms, not just gut feelings or fancy suits, can manage your money, predict market moves, and even execute trades. This isn't just a futuristic fantasy, it's a rapidly evolving field where developers are building tools to automate financial decision-making. But how does it actually try to do that, and what makes it so incredibly difficult? At its core, machine learning in finance is about finding patterns. Imagine a vast ocean of market data, prices, volumes, economic indicators, news sentiment. A human analyst can only process so much, but an algorithm can sift through terabytes of this information in milliseconds, looking for correlations, anomalies, and predictive signals. Projects like the vnpy-Machine-Learning repository on GitHub exemplify this ambition, aiming to create automated systems for everything from personal money management to complex algorithmic trading strategies. It's about turning raw, chaotic data into structured, actionable insights, all without direct human intervention. Traditionally, financial decisions relied on fundamental analysis, technical charts, and human intuition. You'd analyze a company's earnings, look at historical price trends, and make a judgment call. Machine learning, however, approaches this differently. Instead of explicit rules, it learns from data. It's like teaching a child to recognize a cat. You don't give them a list of features, you show them thousands of cat pictures until they learn to identify one themselves. Similarly, these algorithms are fed market data until they learn to predict outcomes or identify optimal trading opportunities. Mathematically, what these algorithms are often trying to do is optimize for something, say, maximizing expected return while minimizing risk. In its simplest form, the expected return of an asset, $R, might be modeled as its average historical return, $mu. But real-world markets are far more complex than just an average. Machine learning models attempt to build more sophisticated functions, $f(x), where $x represents a multitude of market variables, to predict future returns or optimal actions. Essentially, they're trying to find a better, more dynamic $R equals f(x) by learning complex relationships from data. Now, this all sounds fantastic, right? Just plug in the data, and the AI prints money. But here's the catch: markets are messy. They're not always rational, and they're certainly not static. When you see sudden spikes in volatility, like the kind we observe in certain asset classes today, or unexpected shifts in market sentiment, these algorithms face their ultimate test. A machine learning model trained on past data might struggle to adapt to truly novel situations, or black swan events. It's like teaching a robot to drive on a perfect track, then suddenly throwing it into a chaotic, unpredictable street race. So, while the promise of AI in finance is immense, offering speed, efficiency, and the ability to process unimaginable amounts of data, the challenges are equally formidable. It's a continuous arms race between increasingly sophisticated algorithms and an ever-evolving, often irrational market. The goal isn't necessarily to beat the market every single time, but to gain a statistical edge, to manage risk more effectively, and to automate processes that would overwhelm any human. It's a fascinating frontier where math, code, and money collide.